Hey, what's up? Welcome to DGenEd. That's degenerative education, meaning none of this is financial advice. Just me having fun looking at charts and going over some data. And so here in today's video for Sunday, February 16th, I am going to be going over Celsius, ticker symbol CELH, which did close on Friday, February 14th on Valentine's Day at a price of $22.34, coming down nearly 1.5% on the day, but bouncing a little bit in the after hours, going up about 1% and closing the after hours trading session above $22.50. So that is a pretty important level because it was max pain for the 14th and we actually closed below it, which is, to be honest, not really all that surprising just because, the market tends to want to fake us out. And that's exactly what happened on Friday. And so I'm going to go over the daily candles here in the chart, go over the max pain, and then get into some data on unusual whales, going over 3 call contracts, 2 of which I happen to be participating in, and one of them had a pretty big order a couple months ago, and so I wanted to dive into that a little bit. And so, I'll do that towards the end of the video. First, going to go over the chart here. And so, as you can see here, I do have this downtrend that we were trading below for quite some time, going back to, it looks like February 3rd, after we gapped down and then started to go down below this downtrend. But on Thursday, February 13th, we went up by about 6.5% on the day, clearly closing above that downtrend and closing on the 13th at a price of $22.66. So being above $22.50 on Thursday. And then so what happened on Friday is we opened up higher, opening at a price of $23.06. And so people get pretty excited. This is going to be going and closing above max pain. But what we saw was a pullback, this drawdown of 1.41%, closing just barely below $22.34. And if I do switch this over to the 10-minute time frame real quick, we can just kind of see that, we closed up here on Thursday above 22.50 and then slowly fading, up, floating up, before then coming down pretty dramatically and then residing right around that max pain for a couple hours, right around 22. Let's see, we could actually zoom in on this and maybe I could just draw a little bit of, let's see, I don't know how I want to draw this. Let's see. Yeah, I don't think I actually need to do that, but we could just see, the highs over here, 22.57, and then the lows over here, 22.41. So really, just kind of testing people. Are we going to be closing on Friday the 14th above max pain? And then sure enough, in the last hour of the day, not so powerful hour, we do, fade lower and then closed at that price below max pain. So kind of unfortunate there, but I do think there are a lot of things that do look pretty good about the chart. But before I get into the good stuff, I did want to just throw up a Fibonacci retracement here. So going from the low of $21.10 and then going up to the high from Friday, which, let's see, was $23.39. So just making sure that's lined up over there as well as over here. And so that looks good. And so, from this retracement, we can see the golden pocket. It's right around $22 a share. And so the golden pocket is the retracement between the 65% retracement up to the 618, which is a standard Fibonacci level. I just added the 65% just below it. So it gives us that little window there. So I think that price is likely to come down and test $22 a share before it does start to, continue to the upside. But I also did want to point out the 786 here is right around 21.59, so could be coming down towards that level. And I also wanted to point out this 1618 here at $20.81. I was expecting price to go a little bit lower than 2110, which it hit on the 12th, but we actually didn't see that. We did see this nice bounce, and so I don't think this 1618 down here is going to be hit. And you might notice as well that I do have an alert over here at $20.81. And I might actually adjust that. I was planning on adding, or at least just, being alerted if it did go down to there. But I might just adjust that level to $22 a share because I think that we could be coming down to that level to test that golden pocket before bouncing. And so I think that would be a nice dip buying level. If we do actually go down to $20.81, we could just continue with this downtrend. Kind of tough to see where the bottom might be at that point. But, when we did start going down, trading below this downtrend, that was when we gapped down. And so to fill that gap, that would be getting up to the closing price from January 31st, which was at a price of, as you can see over here, $24.98. And then I do have an alert at $25 a share. So when price does get up there, I will be notified of that. And then there's some other levels I did want to point out, taking a step back here further. And so we can see this 1618 that I have drawn here, that is based on this Fibonacci retracement. So going from the low that was hit on November 18th, and then going up to the high that was hit on December 13th. And so from that, we get this 1618 and also the 100% retracement. So that just means a retracement pulling back to that initial pivot point there. That is at $25.23, which was the low on November 18th. Not surprising, that's what it is based on. And so you can see that level over here just above this gap fill and just below this uptrend that I have drawn here based on, it looks like the open price from November 19th, as well as the other pivot point being the closing price from December 30th. And so we did test that over here as support before breaking below it on January 22nd and consolidating, forming a bear flag below that, below that level before we gap down and following this downtrend. And so, those are just, the levels that I have drawn up there. And then I did want to take a step back even further. And I just wanted to point out where this parallel channel comes from. And so that is going back to over here. It looks like I've got the top portion of that parallel channel based on the low from January 28th of 2022, another pivot high, pivot point for the top of that channel being the closing price from May 10th of 2022, as well as the base of that channel being the low from May 10th, 2022, which was at a price of $12.77. And so I just have the parallel channel there just to give me a little bit of a range. So we have the, complete low here, as well as, intersecting with the close from that day. And so that just gives us a little bit of a range. And then if I do, fast forward to where we currently are, maybe slow forward, we can see that the parallel channel is just below us. So I was preparing for, if we do hit $20.81, maybe that's not the bottom and maybe we get to this parallel channel. But the thing that I have noticed about charts like this, when you identify levels like this and they just seem, very obvious, what might happen is that we get very close to that level with a lot of people expecting, if price comes down to sub 20, then I'm going to load the boat. But then, what happens is we hit a low of 21.10, not even hitting $21 a share. Even people at 21 with limit buy orders there, with limit buy orders at 20, they see this, oh, hey, it's breaking out. maybe I should get in on that. Nope, nope. I'm going to be disciplined. I'm going to wait for it to pull back to 21 or 20 for my limit order to fill. And so what I think will happen is those people will get left behind as we do retest the golden pocket here, pulling down to around 22. Maybe we get down to 21.50, but as long as we put in higher lows, so not going below 21.10, I think that would suggest that this breakout is valid. It will be starting to reverse trend and start to go to the upside. We will see this gap get filled at $25 a share. And when that gets filled, those who are waiting down here will then FOMO in, sending this higher. Maybe it gets rejected around 27, 26.50 or so before pulling back, testing that as support, and then continuing higher. So just something to think about there. And then some levels to the upside that I did want to point out. And I think these are relevant for the strikes of the calls that I am currently in. One is this yellow line, which is right around $50 a share. It looks like at $49.30. We can see if we go back in time, there was a little bit of consolidation here below that level, but over here there was a lot of consolidation above it, following consolidation right around it over here. And so as price does get up to around $50, also being kind of a psychological level, half of 100 people might be wanting to take some profits around there. Also, it's more than 100% move from where we're currently at. So, I think that there could be a lot of profit taking there, also coinciding with this prior support now acting as resistance. So it makes a lot of sense. I also do have this level marked here right around $69 a share, actually at a price of $68.41, corresponding with the highs over here, as well as, the midpoint of this little M pattern here. And so, with that having been resistance here, support over here, it may then again be acting as resistance if we do get up to right around $70 a share. And then, kind of tough to miss it, this orange line up here, right around $100 a share. It looks like the prior high, let's see, the 52-week high. I'm not sure if it's the all-time high, but the 52-week high you can see over here, $99.62, which looks like it was hit on, let's see if I can get it. That was hit on Pi Day, so on March 14th of 2024. And then following that, we start to form this M pattern. We get a double top pattern. And what we can see, this is something I've been trying to get better at paying attention to. We pull back up to that high. And what's the difference in volume over here? Actually, no, maybe this is contrary to what I'm thinking about. But, we see, this big spike in volume as we're going up to that level. So not on the exact same day, but we do see this pretty massive increase in volume going up by 31.49 million for this big green candle day, and then it kind of fading as the stock price goes higher. And it looks like volume for the day on Pi Day was 5.16 million. So let's keep that in mind. Over here on this day, volume was, 3.05 million. So as we're attempting to get up to this level of 99.62, volume is lower. Also, the spikes in volume that we're seeing are lower than the one over here. So that does suggest some weakness. That was, in fact, a double top, and we saw a pretty massive drawdown. But, the good news is I think that we are in the near, if not bottom territory, and I think that this could be going a lot higher. And then thinking about the volume down here and these other indicators, I do have the MACD here, and what we can see is that it has been red for quite some time, and it looks like we actually got kind of a fake out here where it looked like it was starting to get closer to being positive, getting back into the green, but then we saw this gap down. So we saw this kind of double hump red here. And so I think that we might be flipping back over into the green, which would correspond with, some moves to the upside. And so hopefully we are starting to see that. And then also looking at the RSI down here, we were recently in the oversold territory. So being below 30, we are starting to turn around. So this might really beat the bottom. Great dip buying opportunity with this starting to roll over, getting back to the overbought territory, which would be above 70 for the RSI. We are not there yet, and there's plenty of upside. So I did want to go over some of those targets and some options contracts that stand out to me. But before I switch over to unusual whales, I did want to point out this date here, December 12th. So, not giving you a spoiler, but there was some unusual whale option activity on that day. And so, I did want to explore that, which is actually some pretty curious data. I'm not sure I understand it that well, but I did want to kind of dive into it and go over, my interpretation of that data, which I think was pretty bullish. But I may actually be incorrect about that, as we did see, a pretty big drawdown. Maybe it was just a little bit early timing the top incorrectly, but it might have been actually getting out of some positions, but that's not what's reflected in the data. So anyways, let's get over to that. And so on the 12th, or right around the 12th of December, I did release this video here, massive Celsius call position opened. And so as far as I understand the data, which we will dive into, that is the video that I am referring to, or this is the contract that I'm referring to in that video. This video, it's only gotten 109 views, so make sure you check it out if you are interested in Celsius. And also, if you do watch that video, you might notice I got long hair and a mustache. So that was I'm actually wearing the same sweater I'm wearing right now. So that's kind of funny. But yeah, no mustache, and my hair is a little bit shorter. And also, too, I did want to note that I did go over Celsius as well as Plug Power in the pre-market prep for Friday. And so if you guys are ever curious to check out, my thoughts, whether it's the S&P 500, the volatility index, Bitcoin, and or other stocks, I encourage checking those out. I'm going to try to do those every day before the market opens. So, I would encourage checking those out if you want some more content from me. But anyways, let's switch over to the unusual whales data. I did want to talk about Max Pain. And so here we are looking at the Celsius data. And what we can see here is that for Friday, February 14th, Max Pain was $22.50. And as I have already talked about, we closed below that level. So it's kind of unfortunate, but I do think that, we did get this nice breakout, and this, red candle day closing below Max Pain, maybe it spooks some people out of going long. Again, just kind of playing with that market psychology, faking us out, hoping that this was going to be closing above Max Pain, and then it pulls back to close below it. What I think we could be seeing in the coming weeks is actually getting to see some closes on Fridays above the Max Pains. But if we look at the future Max Pains, so for February 21st, we see that the Max Pain is $23 a share. So we did get up to above $23 on Friday, hitting a high of $23.39. And so I think it is possible for us to get up to that level by this coming Friday, but it is a shorter week. There might be lighter volume as a result of it. So I do think it is good to kind of manage those expectations. But if we do keep the momentum going, we pull back a little bit, but then bounce to go higher, and we start to close above this Max Pain. The following Max Pain for the 28th is $24 a share. And so if we're able to kind of inch our way above those Max Pains, closing above them, this could trigger, a gamma ramp or gamma squeeze, the stock price continuing to ramp higher, especially because the following Friday, it's the first Friday of March, closing the week on the 7th, Max Pain is $22 a share. And so if we're able to stay around current price for the next 3 weeks, if we're able to go higher, even better. But if we're able to stay around 22, and Max Pain remains at this level, that could really start to trigger some more moves to the upside. So that is what I am looking forward to, over the next couple weeks, the next 3 weeks, to see if we can be closing above these Max Pains. So yeah, I'm feeling pretty good about this, although we didn't close above the Max Pain. for Friday the 14th. But anyways, let's look at some of the data for, the options on Celsius. And so this is looking at the overview for the call and put premium, or I should say the net call and net put premium traded for the day on February 14th. And what we can see with this, along with the premium prices, is that we can see the stock price in yellow. So that did come down over the course of the day, as I had gone over, and we unfortunately in like the last hour of the day really kind of pulled back a lot, getting below that max pain, which we were residing around for a good portion of the day. We can also see that over the course of the day, volume was elevated, and so that suggests that there was more buying of contracts, whether calls or puts. And, that was positive. So whether that's good or bad, we'll have to look at the specific calls and puts, or at least the net premium on them. And so what we can see in red here is that the net put premium was, positive a little bit over here, but generally it was negative and trended down over the course of the day, which is kind of interesting because we see all of this green buying of contracts, but clearly we saw selling of puts. And selling of puts, that's bullish, so that's good. And so all of this volume was probably associated with calls, buying of calls. And so what we can see with the green line up here is that is the net call premium over the course of the day, which started positive, and it looks like it hit a high for the day, going up about $342,000. But then towards the end of the day, a lot of selling, a lot of pressure to the downside. And this actually ended the day negative. And so we can look at the numbers over here. So net put premium came down by $268,000, whereas net call premium came down by nearly $87,000. So both of them came down, so it's kind of neutral, but considering that net put premium came down a lot more than net call premium, which you can see over here, that is more in the favor of the bulls. And if I do slide down over here, we can see this bear bull slider, and 45% is on the bullish side. So that is looking good, although it's not a clear majority because there is this little bit of neutral in there. But just looking at the fact that volume was positive over the course of the day, it looks like it was 903 contracts that were bought. Clearly, those were more than likely not puts because so many more of those were sold, or at least so much more premium came down over the course of the day relative to the calls. And so that would make me think that there was, more buying of calls relative to puts. And even though there was net selling as far as the premium coming down for both of these. And so that does make me think that this is indeed more bullish. So that is looking good. If I do look at some of the past data, let's see, just over the past 3 days, we can see that on Thursday, we saw a pretty big spike in the net call premium going up by $1.41 million. So quite a lot there, whereas the net put premium came down by nearly 800,000. It looks like 780,000. So that is bullish with the net put premium coming down, net call premium going up. So that is looking good. Also with that net call premium being positive, that is, good in the millions. On Wednesday, we didn't really see too much, so let's go back to the past couple weeks, or I should say past 14 trading days. And we've seen some kind of volatility both with calls to the downside and the upside, and puts here to the downside. So on, it looks like February 6th, we saw net put premium coming down by over $1 million. So that is bullish, selling those puts. And then if we look at this over the past 30 days, we can actually see a big spike in puts, the put premium going up over here by over $2 million. But on that same day, we actually see net call net call premium coming down by about 1.5 million. So overall, this was pretty bearish. And following that, we did see the stock price in yellow coming down more. So that does make sense. But, we haven't really seen too much activity, nothing that stands out like this. But maybe we're starting to see a little bit more of that with this trading from Thursday, the net call premium increasing by more than $1.4 million. We haven't really seen that going back in time until we saw this spike here that was January 14th. And so, since I've gone over all this general data, I did want to look up some specific contracts. This is one that I'm really interested in. This is actually the one that the big whales bought, or the whale bought. From what I understand, it looks like the whale bought. But I just first wanted to go over this call contract, just mentioning it. Full disclosure, I do have some of these calls, but I'm a little fish. I don't have a huge position. So, take it with a grain of salt. I am learning here. And so this is the $50 call strike, $50 strike call that expires in June. We got 123 days before this expires. And so, yeah, this is one that I am holding. And another one that I'm holding, this one expires in January of 2026. So got 333 days before this expires. And this is the $100 call, or $100 strike call that expires in January. So this is a leap. And, just looking at the chart that I was just talking about, I got these lines up here, the orange line right around $100 corresponding with that contract that expires, 11 months from now. And then the other one, the $50 call, that expires in a few months, really. Let's see, 4 months or so, getting to June, and that's the $50 strike corresponding with the yellow line that I've gone over. So that's why I picked those. And then as I was looking at these contracts, I had noticed some an unusual spike with this contract. Just, as I was exploring unusual whales, I happened to notice it. And so this is the $40 strike call that expires in July. So got about 150 days before it expires. And the thing that stood out to me, if I scroll down here just to look at the historical volume and all of the information down here, we can see that date that I was talking about, December 12th, if we scroll to it, we can see what I noticed. And that was that there was a volume on the 12th of over 38,000 contracts. And then if we look at the open interest for that day, it was 172 contracts. So this was a massive amount of volume relative to the open interest. So clearly something's going on. And then if we look at the change from the 12th into the 13th, we saw an increase of nearly 38,000 contracts. So this was, as far as I understand it, buying of about 38,000 contracts. And what we can see if we scroll forward in time is that open interest has remained right around 38,000, actually going up to over 39,000. So when those whales bought, or when that whale bought that I point out in this video from 2 months ago, as far as I can tell, they are still holding. And so what I wanted to do, and looking at the data here, I just learned how to do this from actually this unusual whales video. I'm just going to have Ed step aside for a second so you can see it. I'll put a link to this in the description of the video. This is two unusual options trades in KWeb combined for over $5 million in profit. And so this is just a really nice breakdown, and this is actually kind of why I'm getting into this stuff with Celsius. Sorry, it's kind of a long video, and I'm actually going to bring Ed back so I don't forget. Don't want to be doing this alone. And yeah, if I do come back to this data, this is what I had learned from watching that video. And so this is the data from February 14th. I'm not interested in that. I want to go back a couple months. So if I go back 30 days, let's see if we can see a big spike from December 12th. And so this is from January 17th. So this is not what I'm looking for. So I'm going to actually go back 45 days and we can see that spike. And actually, one thing that I should point out that this, kind of got me scratching my head about it a little bit is if we look at this, that candle's primarily red. And if we look at this data when I hover over it, it's primarily on the bid side, which is bearish. Or it would suggest bearish. And following that candle, we see this downside. But since we saw the increase in open interest going from, let's see if I can, I'm fumble with it down here. So trying to get to December 12th. Sorry, the 12th to the 13th is what I want. So, we saw this 38,000 contracts volume traded on that day that went into the increase. And so this spike, even though it's red, even though it's on the bid side, even though it seems bearish, corresponded with opening a position. Even though it was at a top, even though the stock price faded lower, or sorry, this is the average fill, not the stock price, even though that faded lower. And so if I actually show all of the data here, so going back the past 90 days, we can actually see that there was no open interest in this contract before that. So this is just, a big position that was open. And if we look at the fills for the day, the average fill for that day was $4.79. And if we scroll forward to the future for February 14th, the average was, less than $1. So this has come down by quite a lot. And the premium traded for that candle is over $18 million. So quite a lot of money, but that doesn't mean that 18 million can't go to zero. Options are risky. So this may very well go to zero. It may expire worthless. So good to consider that. But then I'm just going to switch this over to 45 days so we can just see this in a little bit higher resolution. This is one of the things that I learned about from that Unusual Whales video that I will link in the description of this one. So if I click on the candle here, I'll get a pop-up that shows me the flow for this day. And so what we can see is there are just these two orders. One was on the bid side, which is the 30,000 contracts. And then one was on the mid side, which is 8,000 contracts. So it makes up that 38,000. So pretty massive orders here. Kind of odd, in all honesty, that it's just these two orders. I was expecting a stream of them. And so what we can see is that while this top one, which is on the mid side, that is neutral, the other one is bearish because it was on the bid side. And so, if I do hover over this, we can see the bearish tag is attached to the trade based on the relation between the option type, call/put, and the side the trade took place on, bid side, ask side. Bid side calls and ask side puts are marked as bearish. And so this is marked as bearish, but that doesn't mean it is bearish, because if we do look at that data from over here, we saw an increase in open interest of, let's just scroll down here so I can do it a little bit quicker. We saw an increase of open interest from, 172 contracts to over 38,000. That is an increase in open interest. More contracts are open. That is bullish, and we see them continuing to be held. We haven't seen another candle this big with those contracts being dumped at a loss over here. So that makes me think, even though the average fill, the premium, has faded down over the past couple months, we still have about 5 months before this contract expires. Relative to the price, the average fill here was $4.79, just to the right of the cursor. You can see that there, $4.79. Now, the average fill from Friday was 93 cents. So if we're even just to get back to break even here, that's a nearly 5x from the average from Friday. So looking pretty incredible there. But anyways, I had clicked on this candle. We, have the information that I got from clicking it. And then now what I want to do is click on the date here, because I can get a little bit more information. We can actually look at these, orders on the day. And so I just wanted to pull that up. So this is the same layout that I see over here. It's just that for, sorry, not that one. For this, it's just that what I have is I am not showing the options volume. And so this should look pretty similar to what we have over here. Wait a second. Oh, this is 3 days, so I'm going to switch that back to 1 day. So yeah, these should look pretty similar. But one thing you might notice, what is up here? You know, we got the calculator, the flow, the alert, and the options here. If we look at the flow over here, we don't have that, but we have the date. And so this is Friday's date, February 14th. And so I can change that to December 12th so we can look at the orders for that day. So I'm just going to scroll down to December 12th, select that, and then we can see the higher resolution orders for that day. And so we see these yellow dots over here. We see that at around 10:45 in the morning on the 12th, there was a mid-sized order for 2 contracts with an average fill of $5. Then at 11 a.m., there was an ask side order filled at an average fill price of $4.70. Then we have another one over here, 2 on the bid side at an average fill of $4.60. And then what we see for this big candle, happens to be the 5 minutes. Let's look at the 1 minute time frame so we get a little bit higher resolution. Still, these orders were placed on the same minute. So this bid side and the mid side. So looking at, I guess I'd have to go back to look at it. Anyway, so yeah, just the 2 orders, the 30,000 and the 8,000, those were filled in the same minute, an average fill of $4.79. So pretty cool to look at the high resolution data there. And then following that big spike, we did see some more buys, but we don't see, the high volume candles. Oh, I don't want to switch that. I want to change this to 5 minutes. We do see, these orders going up following that. We actually see this little green thing at the top there. And so that is because volume has exceeded open interest. If I can just get the cursor to not be blocking that. Yeah, it says, so the cursor's blocking it, sorry, but it says 38,007. And so we could actually see that here just to the left of where the cursor is. You can see 38,007 volume, 38,000 for the daily volume, but this candle volume was 38,002. And actually, if I switch this over to the 1 minute, we can see that this candle, which is just for 1 minute, is for those 38,000 contracts. And then, if I do come back to this, we can see where that spike was. We haven't seen a following, corresponding spike to suggest that, those contracts have been sold. We still have 39,000 in open interest. And, the average fill, the premium is right around $1 per contract versus the $4.79 average fill for this candle. And so that makes me think, and, actually, if we look back at where the stock price was on that date, where was the stock price? That was, let's see, the low for that date was $30 a share. The high, it was about $32. And so looking back over here for this strike of $40, that's still, out of the money at 30, but going from 22 up to 30 would be getting back to when that contract was opened, at that average stock price that it was opened at. And so, yeah, I think that there's just a lot of potential upside for this. That was a $40 strike. I've also mentioned the $50 strike, but this one expires in June, so a little bit more risky. And then the $100 strike for January. I think that price could be getting up to those levels. And, looking at these contracts, I think that there's a lot of potential with them. And, it was really cool to kind of learn more about this data here. And so I hope it was helpful for you guys. But, as always, those are just my thoughts. If you found them helpful, helpful, make sure you like the video, share your thoughts in the comments down below, and make sure you subscribe to the channel for more content like this. Thanks a lot for watching, and have a great weekend and a happy President's Day holiday. Take care, you guys.